Hey everyone, before we dive into this absolute economic tsunami happening in China right now, do me a huge favor and smash that like button and subscribe to the channel because what I'm about to show you is going to blow your mind about the world's second largest economy and how this collapse could affect your wallet, your job, and the entire global economy. Trust me, you do not want to miss this. So here's the deal, folks. China just dropped its economic growth numbers for 2025, and while the official figure sits at 5%, which sounds pretty good on paper, the reality behind these numbers is absolutely terrifying. We're talking about the worst real estate crisis in modern Chinese history, and it's dragging down everything in its path, like a financial black hole. Let me paint you a picture of what's really happening on the ground in China right now. Imagine waking up one day and finding out that your biggest investment, your home, the place where you put your life savings, is now worth 30, 40, sometimes 50% less than what you paid for it. That's not a nightmare scenario. That's the reality for millions of Chinese families right now. The property market, which used to be the backbone of China's economic miracle, the sector that employed hundreds of millions of people and generated massive wealth, is now in complete freefall. Here's where it gets really crazy. For decades, Chinese people had basically one place to put their money: real estate. Unlike in the West, where you can invest in stocks, bonds, mutual funds, retirement accounts, all sorts of financial instruments, Chinese citizens had limited options. The stock market was notoriously volatile and risky. Banks paid almost nothing in interest, and capital controls made it difficult to invest overseas. So what did everyone do? They bought property, and then they bought more property, and then even more. This wasn't just about having a place to live, folks. This was the Chinese dream, the way ordinary people built wealth and secured their futures. Families would save every single yuan they could for years, sometimes decades, just to afford a down payment on an apartment. Parents would buy properties for their children before they even got married because owning a home was literally a requirement for marriage in Chinese society. Can you imagine? Young men couldn't even find a wife unless their family owned property. That's how deep this culture of real estate investment went. But here's the thing that makes this crisis so much worse than what we saw in the United States during 2008 or Japan in the 1990s. In China, people weren't just buying finished homes. They were buying properties that hadn't even been built yet. Developers would sell apartments that were just blueprints, just plans on paper, and buyers would start making mortgage payments immediately, sometimes years before the building was even completed. Think about that for a second. You're paying a mortgage on a home that doesn't exist yet, trusting that the developer will actually finish building it. And for years, this system worked. Developers took the money from pre-sales, used it to buy more land, start more projects, sell more pre-sale units, and the cycle just kept going round and round. The property market went up and up and up. Everyone was making money. Local governments were raking in revenue from land sales. Construction workers had steady jobs. Steel mills, cement factories, glass manufacturers, all the industries connected to real estate were booming. Life was good, until it wasn't. The Chinese government, seeing that property prices were getting absolutely out of control and that developers were taking on dangerous amounts of debt, decided to step in. In 2020, they introduced what they called the 3 red lines policy. Basically, they told developers, you can't borrow unlimited amounts of money anymore. You need to keep your debt under control. Sounds reasonable, right? The problem is the entire business model of Chinese real estate development was built on massive leverage, on borrowing huge amounts of money to fund new projects. When the government tightened the money spigot, the whole house of cards started to collapse. And I mean that literally. Developers who had been juggling massive debts suddenly couldn't get new loans. Projects that were halfway finished ran out of funding. Construction stopped. Cranes went silent. And millions of home buyers who had already paid for apartments that didn't exist yet were left holding the bag. The first major domino to fall was Evergrande, once the biggest property developer in China. This company had total liabilities of over $300 billion. Let me say that again, $300 billion in debt. That's more than the GDP of entire countries. When Evergrande defaulted on its bonds in 2021, it sent shockwaves through the entire Chinese economy and global financial markets. But here's what's really messed up. Evergrande wasn't alone. Country Garden, another massive developer, also collapsed. Sunac gone. Fantasia bankrupt. We're talking about an industry-wide implosion. Estimates suggest that Chinese developers have left more than 20 million apartments unfinished. 20 million. That's enough housing for probably 60 or 70 million people, all stuck in limbo. Now put yourself in the shoes of a regular Chinese family for a moment. You saved for 15 years to afford a down payment. You bought an apartment that hasn't been built yet. You've been paying your mortgage for 3 years, sending money to the bank every single month, like clockwork. And then one day, you go to check on the construction site, and there's nobody there. The cranes aren't moving. The workers are gone. The developer has run out of money, and your apartment might never be finished. What do? You can't stop paying your mortgage because you'll destroy your credit and potentially face legal consequences. But you're literally paying for an asset that doesn't exist. This isn't a theoretical problem, folks. There have been widespread mortgage boycotts across China where desperate homebuyers simply refuse to keep paying for homes they might never get. We're talking about hundreds of thousands of people in this situation. And here's where it connects to these latest economic growth numbers. The real estate sector in China isn't just about building homes. At its peak, property and related industries accounted for something like 25 to 30% of China's entire economy. Construction, building materials, home furnishings, appliances, legal services, real estate agents, mortgage brokers, the list goes on and on. When real estate crashes, all of these sectors crash with it. The data that just came out shows that even though overall GDP grew by 5% in 2025, retail sales only grew by 3.5%. That's a huge red flag. It means that Chinese consumers who are watching their biggest asset lose value every day are scared. They're not spending money. They're saving every penny they can because they've lost confidence in the economy. And when consumers stop spending in an economy that's trying to transition from investment-led growth to consumption-led growth, you've got a serious problem. Let's talk about what the Chinese government has been trying to do to fix this mess. They've thrown everything but the kitchen sink at this crisis. Interest rate cuts? Check. Reduced down payment requirements? Check. Relaxed home buying restrictions in cities where you used to need special permits to purchase property? Check. They've even set up special funds to help developers finish unfinished projects, literally using government money to bail out private companies. And you know what? Despite all of these measures, housing prices are still falling. In major cities like Beijing, Shanghai, and Shenzhen, which used to be untouchable markets where prices only went up, we're seeing declines of 10, 15, sometimes 20% from peak prices. In smaller cities and rural areas, it's even worse. Some properties have lost half their value or more. Here's something that might surprise you. This isn't just affecting rich people or property speculators. This is devastating the middle class, the backbone of Chinese society. These are teachers, doctors, engineers, small business owners who played by the rules, worked hard, saved their money, and invested in what they thought was a safe bet. Now they're watching their life savings evaporate. And it gets even more complicated when you look at local government finances. In China, local governments don't have the same ability to collect taxes that we see in other countries. They can't just raise property taxes or income taxes when they need more revenue. Instead, they've been heavily dependent on selling land to developers. During the boom years, this was a gold mine. Developers would pay massive amounts of money for land rights, and local governments would use that cash to fund infrastructure projects, schools, hospitals, all sorts of public services. But now that the real estate market has crashed, developers aren't buying land anymore. Land sales have fallen off a cliff, down something like 60 or 70% in many regions. This means local governments are basically broke. They can't pay for basic services. They're cutting back on everything from street cleaning to public employee salaries. Some local governments are so desperate for cash that they're trying to collect back taxes from years ago or imposing new fees on businesses. This creates a vicious cycle. Local governments are struggling financially, so they cut back on spending. When governments cut spending, that means fewer jobs, less economic activity, which makes the overall economy weaker, which makes the real estate crisis worse, which further reduces land sales revenue, which makes local governments even more broke. Round and round it goes. Now let's zoom out and look at the bigger picture of what this means for global economics. China is the world's second-largest economy. It's the biggest trading partner for dozens of countries. It's the largest consumer of commodities like iron ore, copper, coal, and oil. When China's economy slows down, when Chinese construction grinds to a halt, the effects ripple around the entire planet. Countries like Australia, Brazil, and Chile that export massive amounts of raw materials to China have already seen the impact. Demand for iron ore is way down because China isn't building as many new apartments and infrastructure projects. Copper prices have been volatile because Chinese construction, which used to consume enormous amounts of copper for wiring and plumbing, has declined sharply. But it's not just commodity exporters who are feeling the pain. Manufacturing countries that sell consumer goods to China's growing middle class are also worried. If Chinese consumers are scared about their financial futures and cutting back on spending, that means less demand for everything from German cars to Japanese electronics to American smartphones. Here's something really important to understand. China's economy is at a critical transition point. For decades, the growth model was simple. Build stuff. Build factories, build apartments, build roads, build bridges, build entire cities. This investment-led growth created millions of jobs and generated impressive GDP numbers. But you can't just keep building forever. Eventually, you run out of useful things to build. You end up with ghost cities where nobody lives, highways that nobody drives on, shopping malls with no shoppers. The Chinese government knows this. They've been trying for years to shift the economy toward more consumption-led growth, where Chinese people buy more goods and services rather than just building more infrastructure. The problem is this transition is really hard to pull off, and the real estate crisis is making it nearly impossible. How are you supposed to get people to spend more money when their biggest asset is losing value? Let me give you some specific numbers that really drive home how serious this is. At the peak of the real estate boom, property sales in China were over $2 trillion per year. In 2025, they're projected to be less than $1 trillion. That's a drop of more than 50%. Half of the market just disappeared. Construction activity, measured by things like cement production and steel consumption, has fallen dramatically. China used to consume more cement in 3 years than the United States used in the entire 20th century. Now cement production is down 20 to 30% from peak levels. Steel production, same story. These industries employed tens of millions of people, and now they're laying off workers left and right. The unemployment situation is particularly grim for young people. Official youth unemployment numbers got so bad that the Chinese government actually stopped publishing them for a while. When they finally resumed reporting the data with a new methodology, the numbers still showed that something like 15 to 20% of young people looking for work couldn't find jobs. And these aren't just any young people. These are college graduates, people with degrees in engineering, computer science, business, who should be the future of China's economy. Why can't they find work? Well, a huge number of entry-level jobs in China used to come from the real estate sector and related industries. Marketing positions at property developers, sales roles at real estate agencies, engineering jobs at construction firms, design positions at architecture companies. All of those opportunities have dried up. And in an economy where real estate was such a dominant force, the ripple effects touch almost every industry. Now here's where it gets really interesting from a policy perspective. The Chinese government is facing a massive dilemma. On one hand, they could go all in on stimulus, printing money, forcing banks to lend, doing whatever it takes to prop up the real estate market and get the economy growing again. This is basically what they did after the 2008 financial crisis, and it worked. China bounced back quickly and helped pull the global economy out of recession. But here's the catch. That massive stimulus after 2008 is actually part of what created this current crisis. All that cheap money flooded into real estate, inflated an enormous bubble, and now the bubble has popped. If they do the same thing again, they might get some short-term growth, but they risk making the underlying problems even worse. They could end up with an even bigger bubble that causes an even more catastrophic crash down the road. On the other hand, if they don't provide enough stimulus, if they let the real estate sector fully collapse and all the bad debt get cleared out of the system, they risk a severe recession or even a depression. Millions more people could lose their jobs. Social unrest could increase. The Communist Party's legitimacy, which is largely based on delivering economic growth and rising living standards, could be seriously threatened. So what are they doing? They're trying to walk a tightrope, providing some stimulus, but not too much, supporting some developers but letting others fail, trying to stabilize housing prices without reinflating the bubble. It's an incredibly difficult balancing act, and frankly, it's not clear that they're succeeding. Let's talk about the international implications of all this. The United States and Europe are watching China's real estate crisis very carefully because they remember their own housing bubbles and crashes. The 2008 financial crisis started with subprime mortgages in the United States and nearly brought down the entire global financial system. Could China's real estate collapse do something similar? There are some important differences. Chinese banks are mostly state-owned, which means the government can control them more directly and prevent the kind of bank runs and financial panic we saw in the West during 2008. Chinese capital controls make it harder for money to flee the country, which provides some stability. And the Chinese government has deep pockets and can step in to prevent a complete meltdown if necessary. But there are also some scary similarities. The amount of debt in China's economy is enormous, possibly even larger than what we saw in the United States before 2008 when you account for shadow banking and off-balance sheet lending. The interconnectedness of the real estate sector with the rest of the economy means that a collapse in property could trigger failures in other sectors. And the psychological impact of watching the middle class lose their wealth could have long-lasting effects on consumer confidence and spending. Here's something that doesn't get talked about enough. The demographic time bomb that China is facing makes this real estate crisis even more serious. China's population is aging rapidly. The one-child policy, which was in effect for decades, means there are fewer young people entering the workforce and more old people retiring. In a country with a limited social safety net, where people depend on their savings and their property wealth to fund their retirement, a real estate crash is absolutely devastating. Think about it this way. If you're a 60-year-old Chinese person who worked your entire life, saved diligently, and invested in property to fund your retirement, and now that property is worth half what it used to be, you're in serious trouble. You can't just go back to work. Your earning years are behind you. This is creating a generation of people who thought they were set for retirement, but now face financial insecurity. And it's not just about individual hardship. When a large portion of your population is elderly and financially stressed, that puts enormous pressure on government services and the younger generation. Fewer young workers have to support more retirees through taxes and family transfers. This is a recipe for social tension and economic stagnation. The Chinese government is acutely aware of these demographic challenges, which is why they've completely reversed course on the one-child policy and are now encouraging people to have more children. But here's the problem. People aren't responding. Birth rates continue to fall because young people look at the economic situation and think, how can I afford to have kids when I can barely afford to take care of myself? When housing is still expensive despite the crash, when jobs are scarce, when the future looks uncertain. This brings us to another crucial point. China's real estate crisis is happening at the same time as major geopolitical tensions, particularly with the United States. Trade wars, technology restrictions, concerns about Taiwan, all of these factors are making foreign companies more hesitant to invest in China. Some manufacturing is moving to other countries like Vietnam, India, and Mexico as companies diversify their supply chains. This shift, sometimes called de-risking or decoupling, means that China can't necessarily count on foreign investment and exports to drive growth the way it did in the past. The economy needs to rely more on domestic consumption, but domestic consumers are scared and cutting back because of the real estate crisis. You see how all these problems feed into each other? Let me give you a concrete example of how this affects ordinary people's lives. There's been a trend in China called lying flat, where young people essentially opt out of the rat race. They're not buying homes, not getting married, not having kids, not pursuing high-pressure careers. They're just doing the minimum to get by. Why? Because they look at the previous generation who did everything right, worked incredibly hard, saved and invested in real estate, and still ended up in financial trouble. They think, what's the point? The game is rigged, the system is broken. Why should I kill myself trying to succeed? This kind of social mood, this loss of optimism and ambition, is incredibly dangerous for an economy that needs dynamism and entrepreneurship to transition to a new growth model. You can't innovate your way to prosperity if your most talented young people have given up on the future. The Chinese government has been trying to crack down on this lying flat mentality, calling it irresponsible and unpatriotic. But you can't really force people to be optimistic through propaganda when the economic fundamentals are genuinely concerning. Actions speak louder than words, and the action of watching real estate values collapse speaks pretty loudly. Now, let's talk about some of the attempts to fix this mess that have been tried and haven't worked. The government has encouraged banks to lend more, but banks are hesitant because they're worried about bad loans. They've encouraged people to buy homes with lower down payments and cheaper mortgages, but people are scared to take on debt when prices might keep falling. They've tried to support developers with bailouts and special funds, but many developers are so deeply in debt that even government support isn't enough to save them. One policy that has been particularly controversial is trying to convert unsold apartments into affordable housing or rental units. In theory, this makes sense. Take all these empty apartments that developers can't sell and turn them into something useful for people who need housing but can't afford market prices. In practice, it's really complicated. Who pays for the conversion? Who manages the properties? How do you determine fair rent? And does this just create more oversupply and push prices down even further? There have also been efforts to boost other parts of the economy to make up for the real estate slowdown. The government has invested heavily in green technology, electric vehicles, solar panels, wind turbines, trying to create new industries that can drive growth. China is now the dominant player in many of these sectors, producing most of the world's solar panels and electric vehicles. But here's the problem. These industries, while important for the future, don't employ nearly as many people as real estate and construction did. A solar panel factory might employ a few thousand workers. A real estate boom employed millions. You can't make up for the loss of one with the other, at least not quickly. There's also been a push to develop China's technology sector to become a leader in artificial intelligence, semiconductors, biotechnology. The government is pouring money into these areas and restricting foreign competition to give domestic companies an advantage. But again, tech industries tend to be less labor-intensive than traditional manufacturing and construction. And with the United States and other countries imposing restrictions on technology transfers to China, it's getting harder to acquire the cutting-edge knowledge and equipment needed to compete at the highest levels. Let me share some absolutely wild stories that illustrate just how desperate the situation has become in some parts of China. There are reports of local governments literally painting grass green to make it look better for inspections because they can't afford proper maintenance. Officials have been caught faking economic data to make their regions look better than they actually are. Some cities have resorted to extremely aggressive tax collection tactics, going after businesses and individuals for any possible revenue source. In some regions, there are entire residential developments that were built but never occupied, ghost cities where the buildings are there but nobody lives in them because the economic opportunities that were supposed to attract people never materialized. It's surreal. You can walk through neighborhoods with high-rise apartments, shopping centers, schools, all the infrastructure of a functioning city, but it's completely empty. It's like a post-apocalyptic movie, except the apocalypse was economic rather than nuclear. The human cost of all this is staggering. We're talking about families who have lost their life savings, young people who can't afford to get married or have children, middle-aged workers who have been laid off and can't find new jobs, elderly people whose retirement security has evaporated. These aren't just statistics. These are real human beings dealing with real financial and emotional stress. There have been reports of increased mental health issues, depression, and even suicide related to financial stress from the real estate crisis. People who invested everything they had and lost it all. Developers who built successful companies over decades and watched them collapse. Workers who were proud of their skills and their contributions who suddenly find themselves obsolete. And here's something that's particularly heartbreaking. There's a generation of children in China who were born during the boom years, whose parents told them that if they worked hard and got a good education, they could have a better life than their parents had. Now, those kids are graduating from college into an economy with few opportunities, and they're realizing that the promise their parents made might not come true. The social contract, the idea that each generation would be better off than the last, has been broken. What does the future hold? That's the million-dollar question, or more accurately, the multi-trillion-dollar question. Some analysts think China can muddle through, that the government will provide just enough support to prevent a total collapse while slowly working through the excess debt and oversupply. This would mean years, maybe even a decade or more of slower growth, but not a catastrophic crash. Others are more pessimistic. They point to Japan's experience in the 1990s, the so-called lost decades, where a real estate bubble burst and the economy stagnated for 20 years. They worry that China could face a similar fate, especially given the demographic challenges and the difficulty of transitioning to a new growth model. Japan at least had a wealthy population with high savings when its bubble burst. China is still a middle-income country with hundreds of millions of people who aren't wealthy yet. There's also a more optimistic scenario where China successfully pivots to a consumption and innovation-driven economy. In this view, the real estate crisis, while painful, is actually necessary to clear out the excesses and misallocations of the old growth model. Once the bad debt is cleaned up and resources are redirected to more productive uses, the economy can start growing in a healthier, more sustainable way. Chinese companies could become global leaders in technology, clean energy, and other advanced industries. Which of these scenarios will actually play out? Honestly, nobody knows for sure. The Chinese economy is so large and complex with so many moving parts and so much government intervention that it's really hard to predict. What we do know is that the real estate crisis is real, it's serious, and it's having significant effects both within China and around the world. For those of us watching from outside China, there are a few key things to pay attention to. First, watch consumer spending data. If Chinese consumers start spending again, that's a good sign that confidence is returning. If spending continues to decline, that suggests the crisis is getting worse. Second, watch the property market itself. Are prices stabilizing or still falling? Are developers able to finish unfinished projects, or are there more defaults? Third, watch employment data, especially youth unemployment. If young people can't find jobs, that's a really bad sign for the future. And perhaps most importantly, watch government policy. Is Beijing providing more stimulus or pulling back? Are they letting more developers fail or bailing everyone out? The choices the government makes in the coming months and years will largely determine whether China experiences a controlled slowdown or a chaotic crash. Here's what this all means for you, regardless of where you live. If you're invested in global stock markets, China's economic health matters because so many companies depend on Chinese consumers and Chinese supply chains. If you work in manufacturing, commodities, or any industry connected to global trade, China's slowdown will affect demand and prices. If you're concerned about geopolitical stability, a China dealing with serious economic stress might behave differently on the world stage than a confident, rapidly growing China. The really big question that keeps economists up at night is this: can China avoid a hard landing? Can they manage this crisis without triggering a recession that spills over into the global economy? Or are we heading for another 2008-style financial crisis, except this time originating in Beijing instead of Wall Street? The stakes are incredibly high. We're talking about the economic futures of 1.4 billion people in China and the stability of the global economy that we all depend on. This isn't just some distant problem happening on the other side of the world. In our interconnected global economy, what happens in China affects all of us. So here's my challenge to you: stay informed about this story. It's not as flashy or exciting as some other news, but it's arguably one of the most important economic stories of our time. The decisions being made right now in Beijing, the actions being taken by Chinese consumers and businesses, the response of the international community, all of these things will shape the global economy for decades to come. If you found this deep dive valuable and you want to stay updated on how this crisis unfolds, make sure you're subscribed to the channel and hit that notification bell so you don't miss future updates. Drop a comment below and let me know. Do you think China can successfully navigate this crisis, or are we heading for a major economic disaster? I read every single comment, and I'm really curious to hear your perspectives. The Chinese real estate collapse is a massive story that's still unfolding. We're watching in real time as the world's second-largest economy grapples with perhaps the biggest financial crisis in its modern history. The outcomes will affect all of us, whether we realize it or not. Stay informed, stay engaged, and I'll see you in the next video where we'll continue to track this developing situation.